Module 4: Benefits and Criticisms. Without further ado, let us start this module instantly, focusing on the advantages of structured finance. We all know that traditional lenders do not offer structural financial products. Still, then they become adamant that companies must satisfy their capital integration needs, which cannot be covered through old-school methods. One thing you should always remember is that such instruments are non-transferable. So there is no movement possible between different kinds of debts. The very first advantage of structured instruments is asset-backed securities. We have already discussed how it is one of the most significant types of structured financial instruments. They have floating interest rates and help big corporations to protect themselves against higher interest rates. They are either bonds or notes, secured through a fundamental assets pool. Their structure depends on the issuer, seller, and investor, and it mostly comprises mortgage loans like home equity loans, auto loans, credit card receivables, and so on. Apart from these, there are credit default swaps, syndicated loans, and insurance-linked securities that are present to assist an investor or entity. The insurance-linked securities help in transferring the risk of loss to insurance due to catastrophic events, mostly unrelated to traditional financial markets. Then, there are syndicated loans offered by a group of lenders arranged by a consortium of different commercial or investment banks. And yes, the credit default swap is a particular advantage as it is purchased protection by one party from the other against the losses that may occur in case a borrower defaults for a particular period. This instrument serves as a contract between two parties. Moving ahead, the simple advantages of structured finance come in the form of borrowing funds and using the cash flow as security rather than companies putting physical assets as collateral. With structured finance, lenders reduce the risk, which aids in lowering interest rates and inducing better terms. At the same time, we should not forget that it serves as a tool for injecting substantial capital into a business or company. With mortgage-backed securities, the investors formulate periodic payments like bond coupon payments. Let us inform you that in the first quarter of 2022, the amount of credit derivatives hiked from $964 billion to $4.5 trillion American dollars. Although this is an estimated value, the increase is caused because the credit derivative allows the lender to shift the debt instrument's credit risk to a third party for a particular fee. The lender is defended against the loss related to the default risk by the borrower. Taking this further, there are 5 main reasons why structured finance is better. The first one is purpose. Structured finance helps in regulating and fixing the long-term and immediate needs of the businesses that cannot be catered to through traditional ways of financing. The second is security. By indulging in structured finance, big corporations secure themselves from any form of market risk and operational inefficiencies. These tailor-made financial instruments are specifically designed to help big corporations maintain cash flow and use it as collateral. The third benefit is the amount, which in the case of structured finance is very big compared to conventional methods of financing, and that's why big companies prefer structured finance. The fourth benefit is pricing. One of the main reasons why borrowers are attracted to structured finance is the minimized capital cost. The structured finance instruments are specifically designed with light costs. The pricing may include other expenses, such as advisory and processing fees, along with the onboarding charges. And the last one, in terms of lending. Again, it goes without saying that big companies find structured finance with easy terms of lending that allow them to remain flexible in the market and their business operations and transactional obligations. The terms are widely accepted across industries. However, it is advised that management should always go through the agreement to ensure the right policies and terms are being employed. So, we are finished with the benefits of structured finance. Now, we know that the financial markets all around the world suffered the most during the financial crisis of 2008. So let us walk through some of the key lessons that we learned from it and how it shaped the structured finance market and industry that we experience and operate in today. The number one lesson we learned, and which we cannot deny, is that the United States government was at major fault in encouraging large-scale expansion of mortgage lending, so much so that they gave loans to technically anyone and everyone who was most likely to default. Today, with the help of structured finance, corporations take a close look and think carefully about interest rates, risk tolerance, credit issues, and all other factors that were completely ignored during the 2008 crisis. The second lesson is not to operate based on assumptions like the assumption of large American banks that the mortgages were well protected because Fannie and Freddie backed them. Moving on to our third lesson from the financial crisis of 2008 comes from the ignorance that authorities in the system showed toward the importance of accountability. The bailing out of people and companies gave rise to worse consequences, and we all can agree to the fact that a system with zero accountability cannot work and eventually meet its fate. When it came to the sense of people that the false mortgages backed the securities, it completely shook the market and the global economy. Today, the entire structured finance system, industry, and every single financial product is meticulously designed and backed by the right mortgages and securities. It facilitates credit risk transfer and creates safe assets. Many structured tranches are safer than average illiquid assets along with the underlying pool due to the priority system utilized in claim structuring. On that note, we conclude this course. This has been an exciting ride full of learning and knowledge. We believe that not only from the basics point of view, but from a higher perspective, we covered the essentials of structured finance. Starting from the fundamentals, we reached to analyze the core crux applications, scope, and vastness of structured financial instruments, describing their type, benefits, history, problems, and more importantly, making key mental notes of the issues that not only big corporations, but banks, financial institutions, and investors come across. In this course, we also covered the key lessons that we learned and what shaped the structured finance market that we see today. We sincerely hope that you gained maximum knowledge from this course and look forward to seeing you apply the same for your personal financial growth. Thank you, and all the best.